The idea behind this convention is to enable the users of financial statement to make proper decisions. Convention of materiality tells us record those transactions in the books of account which is material or which is significant in nature, and immaterial transaction has to be ignored. When once a particular method of depreciation is adopted for a particular fixed asset, so it can be your straight line method or written down value method. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. My dear students, today I am in the last session of your Unit 1, and the Unit 1 is Introduction to Financial Accounting, and this is under the subject Fundamentals of Business Accounting for first sem BBA students of Mysuru University. So, in your previous session, we have discussed few of the important concepts relating to this particular unit. So, wherein I have told you, you will get a 15 marks or 10 marks question from accounting concepts. So, we have learnt about accounting principles. Under that, we have accounting concepts and accounting conventions. And accounting concepts is a very important topic, and in your 5th session, we have discussed about all the accounting concepts. In today's session, we shall continue with accounting conventions. Now, let us see what are the accounting conventions we have in accounting which has to be followed while recording in the books of accounts. So, important accounting conventions are, so you have the first one, convention of materiality or materiality concept. Now, what do you mean by material and immaterial? Material means what? Which is very important or which is very significant. So, this convention tells us record those transactions in the books of account which is material or significant in nature, and immaterial transactions has to be ignored, because in a particular day there are crores together of transactions that takes place in a big organization. So it's not that we have to record all the transactions in the books of account. So in order to get the exact financial position of the business, we are going to take into consideration only those transactions which are material in nature, which is significant in nature, so that a proper financial statement can be drafted. So immaterial transaction has to be ignored. So that would be the explanation of convention of materiality. Now go through this. It means in accounting, a detailed record is made only of those business transactions which are material, that is significant to the users of accounting information. So unnecessary transaction we need not record. It is wastage of time. At the same time, it is waste also, because without those immaterial transaction, we can't draw a meaningful conclusion. So what you have to do? Record only those transactions which is material in nature, so that a proper financial statement can be drafted and it can be communicated to the users. No detailed record is made of those transactions which are not material or which is immaterial in nature. So we need not record those immaterial transactions at all in our books of accounts. For example, according to materiality convention, when a pen worth rupees 20 is put to use, the entire amount of rupees 20 is treated as expense immediately, though the pen may be used for a few days. When I purchase a pen of rupees 20, I have paid rupees 20, correct? So it is left to me that whether I have to use that pen or not. But in the books of account, what I have to do? So, of course, 20 rupees has gone out from me. So, I have to record in the books of account whether that pen is put to use or whether I don't use that pen or not. But I have spent the amount. Still, I have to record in the books of account, even though if I don't use that pen in the business activities. So, this would be the best example for convention of materiality. So, convention of materiality tells us record those transactions in the books of account which is material or which is significant in nature, and immaterial transaction has to be ignored. Next, the second one is convention of conservatism or conservatism concept. So, here this concept or convention tells us always be prepared for the worst. Don't always think that, don't always have that overconfident that business would always be in profit. Be prepared for the loss also. So for which you might have heard about reserves, correct? Reserve for bad debts, reserve for doubtful debts. Now why that reserve has to be kept in the business? To face the future uncertainties. So be prepared for the worst. That is convention of conservatism. Play always in the safer side. It means that in accounting records and in the financial statement of a business, all prospective losses should be considered and provided for, but prospective profit should be ignored. So don't always have that intention that our business will be in profit. Suppose all of a sudden, if the business is in loss, then you should be able to cope up with loss also. So for which what you have to do? You have to be in a safer side where you have to keep some amount as reserves. Whenever the company earns more profit, a part of the profit is kept as reserve to meet the uncertainties in the business. Uncertainty is nothing but loss in the business. So this convention of conservatism tells us always be prepared for the worst. So don't always anticipate the profit. So don't always think that the business will be in profit. Be prepared for loss also. In short, according to this convention, provide for all possible losses but anticipate no profit. So valuing closing stock at cost or market price, whichever is lower. So always be prepared on the safer side. Be on the safer side. So whichever is lower, creating provision for doubtful debts or creating provision for bad debts. So are some of the example for application of principle of conservatism. So time being, you remember what is principle of conservatism or convention of conservatism. Always be prepared for the loss. Don't always think that the business will be in profit. Be prepared for the uncertainties that comes in the future also. The third one is convention of consistency. So what do I mean by consistent? Same. So here convention of consistency tells us, suppose being a business organization, if you are following a particular method, then follow the same method year after year. Don't change the method often and often. So when you keep on changing the methods, so suppose for example calculation of depreciation. So there are various methods to calculate depreciation like straight line method, written down value method. Suppose if you are following a particular method, follow the same method year after year. Don't change the method. So when you change the method, then the accounting results will also change, where you can't compare your accounting result from one year to that of another year. So this consistency means what? You're going to follow the same method. Don't keep on changing the method. If you keep on changing the method, then the comparison gets difficult. So your accounting information cannot be compared from one year to another year. So, convention of consistency or consistency concept, it means that the accounting policies and practices should remain consistent, which means that it should be same. That is uniform or unchanged from one accounting year to another. So, this I've already told you. So, being an accountant, don't keep on changing the methods. Follow the same method. So what happens when you are following the same method? The accounting result drafted will also be same. At the same time, your comparison from one year to another year will also be easy. Example, when once a particular method of depreciation is adopted for a particular fixed asset, so it can be your straight line method or written down value method, the same method should be followed for the asset year after year. According to Indian accounting standard, consistency is a fundamental assumption. So these are all assumptions what you have to follow while recording in the books of account. This convention enables a meaningful comparison. So why we can't change the methods year after year? Because the comparison becomes difficult of the accounting figures of one year with that of another year. So hope you are clear with convention of consistency, which means that follow the same method year after year. Don't keep on changing the methods. Next, fourth convention is convention of full disclosure. Here the word itself tells us disclose, or when you are recording in the books of accounts, so disclose all the details, all the information in detail. So that would be convention of full disclosure, because after a few years, suppose if you go back and see your books of account, so if there is no proper explanation for that, or if there is no proper narration which has been written in that particular transaction, so you can't understand those transactions. So whatever you are going to record in the books of account, write in detail. So disclose everything, even though it is a small amount, or even though if you feel that it is very simple, but still you have to record in the books of account. For example, when we are solving a problem, wherever necessary, we will prepare the working note. So it also means that we are disclosing everything. So whatever I know, instead of directly writing the amount, so I can show and write the amount. I can show the calculation, which means that I have to disclose everything, so that after few years also I'll be able to see the difference. So I'll be able to identify what are the transaction, how the adjustment is made. So that is your convention of full disclosure. It means that all material facts. So this also you have to remember, full disclosure is nothing but all the immaterial facts that you have to disclose. Disclose a material fact which is significant in nature relating to accounts must be disclosed in the financial statement with sufficient details. So wherever necessary, we have to give the proper working note or proper explanation. For example, for your journal entry, so we'll write in the bracket those narration. So why do we write the narration? So narration is a brief explanation of your journal entry. So when you see the narration, you can easily understand why you have written the entry. Correct? So that would be your disclosure, full disclosure. Example, in case of sundry debtors, not only the total amount of sundry debtors should be disclosed, but also the amount of good as well as secure debtors and the amount of doubtful debt should be mentioned. So you might have experienced about it. So when you are writing in the balance sheet, so in the asset side, you will write the debtors minus PDD, minus RBD. So all these you will show. In the same way, for example, if there is a fixed asset, so you will write machinery minus depreciation. Suppose if you directly deduct and write in the outer column, you will not be able to understand later on. So wherever necessary, we have to give the proper explanation. The idea behind this convention is to enable the users of financial statement to make proper decisions. So in order to make the financial statement understand properly, at the same time in order to make the proper decisions. The practice of giving notes related to various facts or items which do not find place in the accounting statement is according to this convention. So wherever we don't, so in your financial statement, we can't include everything and record in the financial statement. So a proper necessary notes or proper explanation should be written afterwards. So that is about your convention of full disclosure. So there are 4 conventions. So convention of materiality, convention of conservatism, convention of consistency and convention of full disclosure. So hope you have understood about this accounting conventions. Now moving on to the next concept, let us see the difference. Now you know what are accounting concepts and what are accounting conventions, correct? So in your previous session we have learnt about accounting concepts and now we have learnt about accounting conventions. So let us see what is the difference between accounting concepts and accounting conventions. Now coming to the first one, that is basis of distinction, accounting concepts and accounting conventions. So the first one is legal position. So let us see what is the legal position of accounting concepts and accounting conventions. So accounting concepts have legal acceptance. So it can be accepted legally, accounting concepts. Whereas accounting conventions are guidelines based on custom, usage or general agreement. So how this has been accepted? It has been accepted as a guidelines based on custom or by usage or general agreement. So this would be the first difference. Second one is recording versus financial statement. So recording will be done in the first stage of accounting. That is, after identifying, we will measure the transaction, then we will start recording the transaction. But financial statement is prepared at the end of the year. Now let us see what it is. Accounting concepts are the basic assumptions on the basis of which transactions are recorded and accounts are maintained. So your accounting concepts are used in the recording stage itself. Whereas accounting conventions are followed in preparing the financial statement. That is, at the end of the year, we'll prepare the financial statement, that is profit and loss account and balance sheet. So this is used while recording the transaction, whereas accounting conventions is used while preparing the financial statement, that is end of the year. Next, significance. These are the uniform set of rules usually followed in recording the transaction. So I have already told you. So what is the significance of accounting concepts? So these are the uniform rules. In a sense, same rules and regulations to be followed while recording the transaction. What about accounting conventions then? These are not so important as accounting concepts. If your recording goes wrong, of course your preparation of financial statement also goes wrong at the end of the year. So your accounting conventions is not that important as accounting concepts. Next, role of personnel. So whether there is a personal bias in the accounting concepts or in the accounting conventions. There is no role of personal judgment or individual bias in following the accounting concept. So here individual judgment or personal opinion cannot be followed under accounting concepts because these are the uniform rules and regulations and it has to be followed. Whereas accounting conventions, personal judgment might be there. Personal judgment play a crucial role in the adoption of accounting convention. So in your accounting concept, there is no personal judgment or bias of an accountant, whereas in accounting conventions, personal judgment plays a very important role. Next, uniform adoption. There is uniform adoption of accounting concepts in different enterprise. So I have told you these are the uniform rules and regulations and it has to be followed by everybody. Okay. Whereas in accounting conventions, there is no uniformity in the adoption of accounting conventions in various enterprise. So there is no uniformity. So every organization need not follow the same rules and regulations like accounting concepts. So that would be the difference between accounting concepts and conventions. So hope you would have got an idea what is the difference between accounting concepts and conventions. Now moving on to the next important concept, that is accounting standards. So from the examination point of view, so you might get a question, what is accounting standard? Write the objectives of accounting standards. Now first let us see what is this accounting standard. Then later on we shall see what are the objectives. Why do we need this accounting standard? So what are the limitations? All that we shall see in this particular session. Now what is this accounting standards? Accounting standards can be any form of statement which consists of rules and guidelines. So what does accounting standard contains? It contains rules and guidelines. It tells how the transaction has to be recorded, or it gives the guidelines how the transaction has to be recorded, when to record, how the adjustments has to be treated. All these will be given by whom? Accounting standards. So issued by the accounting institutions for the preparation of uniform and consistent financial statements. Now what do you mean by accounting standards? So these are the rules and regulations or rules and guidelines issued by whom? Issued by the accounting institutions. The main intention is to bring uniformity and consistency in the books of accounts. Accounting standard is an authoritative statement issued by ICAI, Institute of Chartered Accountant of India, a professional body of accounting in a country. So this accounting standard is given by ICAI. The main intention is to bring uniformity and consistency in the books of account. So it is nothing but the rules and guidelines to be followed while recording in the books of accounts. The objective of accounting standard is to bring uniformity in different accounting policies in order to eliminate non-comparability of financial statement for enhancing reliability in financial statement. So when you are following uniform rules and regulations or same rules and regulations, what happens? Every company will be following the same rules and regulations. So thereby your financial statement will also be uniform. And then you can compare your financial statement with that of another, as well as from one year to another year. Secondly, the accounting standards provides a set of standard accounting policies, valuation norms and disclosure requirements. So it contains a bundle of rules and guidelines to be followed while recording or how to maintain the books of accounts. So that would be the accounting standards. Now, let us see what is the need for accounting standard. So, the first one is accounting extends information to various users of information. Now, why we have to follow this accounting standard? Because anyhow, our financial result has to be communicated to the users. Suppose if you want to communicate it to the users, of course, your accounting information should be reliable. So, this accounting standard helps us to maintain a proper books of account and thereby a proper result or a accurate result can be communicated to the accounting users. Second one is accounting information can serve the interest of different users only if it possesses uniformity and full disclosure of relevant information. So when you're following accounting standard which contains a set of rules and guidelines, so then what happens? Your accounting information or whatever the accounting results you have maintained, it will be uniform. At the same time, all the things, all the material aspects will be included. There will be full disclosure of relevant accounting information in your financial statement. Next one is, there can be alternate accounting treatment and valuation norms which may be used by any business entity. So, when you have a particular set of rules and regulations, then you will follow that particular set of rules and regulations and maintain your books of accounts. If there is no, then each and every organization will follow their own methods. Then the relevant information cannot be communicated. Next is, accounting standard facilitate the scope of those alternatives which fulfill the basic qualitative characteristics of true and fair financial statement. So, I have already told you, when you are following a set rules and regulations, then your quality of your accounting information will also be good. At the same time, it can be openly communicated to the users. So, this would be the need of accounting standards. Now, let us see what are the limitations. So, of course, I have told you these are the rules which has to be followed. When it is rule, which means that it is compulsory to be followed by each and every organization. So, let us see what are the limitations of accounting standards. So, the first one is, accounting standards make choice between different alternate accounting treatments difficult to apply. So, when you have different alternate treatments in your accounting standards, it is very difficult to apply for a company, because when a person who is not having sufficient knowledge about accounting, then that person cannot apply. So, you should have a proper knowledge about accounting standard, then only it can be applied in the books of accounts. Next, it is rigidly followed. Rigid means what? It has to be followed. So, you can't change the rules. So, it has to be followed. So, it is rigidly followed and fails to extend flexibility. There is no flexibility because you can't change the rules and regulations and the accounting standards. So, you have to follow, and it is very rigid in nature. Next, third one is, accounting standard cannot override the statute. The standards are required to be formed with the ambit of prevailing status. So, you can't change that. So, what you have to do? So, you can't override any of the accounting standards. When you are following accounting standard, it has to be followed in a proper way according to the rules and guidelines given by the accounting standard. So, you can't override that. So, this would be the limitations of accounting standards. Now, let us see applicability of accounting standards, where these are applicable. Okay. So, except the purely charitable organization, except these charitable organizations which does not have any commercial or industrial and business activity, accounting standard is applicable to. So, except charitable organization who does not involve in commercial business as well as industrial activities, they need not follow the accounting standard. Other than that, all the following institutions or organizations have to follow the accounting standards. So, they are sole proprietorship units, that is nothing but your sole trading concern, partnership firm, societies, trust, Hindu undivided family, association of persons, then cooperative society, companies, etc. So, these have to follow the accounting standards. Next, so this you have already learned the meaning of accounting standards. So, this would be a 10-mark question. So, that would be a 10 marks question in your examination. You can expect this question. What is accounting standard? Write the objectives of accounting standard for 10 marks. Okay. So, let us see what is this accounting standard. Already you know about it. So, what is accounting standard? So, these are the rules and guidelines which is given by the accounting institutions in order to follow while maintaining in the books of accounts to bring uniformity and consistency. Correct? So, let us see the meaning. Accounting standards can be any form of statement which consists of rules and guidelines. So, it consists of what? Rules and guidelines issued by the accounting institutions. So, there are certain institutions, accounting institutions or certain organization and prominent accountants have come together and they have framed a standard rules and guidelines. which is called as accounting standard, and it has to be followed while maintaining the books of accounts for the preparation of uniform and consistent financial statement. So the main intention is to bring uniformity and consistency in the financial statements. So this also includes disclosures required by different users of accounting information. It contains detailed information how you have to treat each and every transactions in your financial statements. So that would be the meaning of accounting standard. Now the other part of the question is objectives of accounting standards. So of course now you would have got an idea what is the meaning. So if you know the meaning, then you can easily write the objectives of accounting standards. So the first one is the main aim is to improve the reliability of financial statements. So your financial statement should be in such a way that it has to be reliable in nature. So there should be accuracy in the financial results, that is your financial statement. At the same time, it has to be reliable by the users. So that would be the first objective of accounting standard, that is to improve the reliability of financial statements. Second one is accounting standard help in comparing inter-firm as well as intra-firm. Inter-firm means what? You are going to compare your accounting results inter-firm. Inter-firm in the sense, suppose if there are various departments, how the departments are actually working. So when they are maintaining a proper accounts, how each and every department works. So it may be your production department, your selling department, or your marketing department, how each department works. That is inter-firm. Intra-firm in the sense from one organization to another organization outside. What is your actual position when you compare in your market, when you compare to your competitor? That is inter-firm and intra-firm comparison can also be made. This allows to check the progress of the firm and its position in the market. So progress of the firm in the sense by seeing the various departments activities, so you can able to see whether the business is progressing or not. At the same time, what is your position in the market? When you see your competitors, what is your actual position in the market? Next, third one is it also looks to provide one set of accounting policies that includes the necessary disclosure requirements and the valuation method of various financial transactions. When you take the financial statement, how each and every transaction has to be taken into consideration. A detailed information will be given by the accounting standards. Next is attains uniformity. Of course, the main intention of your accounting standard is to bring uniformity in the accounting statements. So, to bring attains uniformity in accounting standards provides rules for standard treatment and recording of transactions. They even have a standard format for financial statements. So, that tells us how you have to prepare the financial statement. What is the actual format? What type of transactions you have to take? So, all these details will be given. So, thereby when every company are following this rules and guidelines, then it brings uniformity in the accounting results. Next, prevents frauds. Of course, when you are following a proper rules and regulations, of course, it reduces in frauds and errors. So, prevent frauds and accounting manipulations also. Manipulation means what? Showing the fair accounting results to your users. That is known as what? Manipulation. So, manipulation as lay down the accounting principles and methodologies that all entity must follow. So, when you are following same rules and guidelines or same method if you are following, it helps to reduce the frauds as well as manipulations. Nobody can cheat because rules is for everybody. So, nobody can cheat in the preparation of financial statements. So, following those standards is not optional, it is compulsory. So, this is very important. Since it is compulsory, everybody have to follow that. So, these standards make it difficult for the management to misrepresent any financial information and makes it harder for them to commit any frauds. When each and every company has to follow compulsory all the rules and regulations, guidelines given by the accounting standards, then there will be less chance of fraud as well as manipulations in the books of accounts. Next one is assist auditors with regards to all accounting policies, rules, regulations, etc. in a written format. These policies have to be followed. Even not only the accountant, even the auditor should also follow the accounting standards while auditing the books of accounts. Next one is determining managerial accountability by measuring the performance of management of the entity. So when a proper management, so when you have a efficient management in the organization, then that efficient management will be judged based on the accounting standards, because when you are following a systematic accounting standard and maintaining the books of account, of course the management efficiency will also increase. So this would be the objectives of accounting standards. A very important question for 10 marks, or they might ask for 15 marks also. Usually they might ask for 10 marks. What is accounting standard? Write the objectives of accounting standard. Now here I have given you 7 objectives with the meaning and explanation. It would be 10 marks. Next, let us see what is the difference between IFRS and Indian Accounting Standards, that is International Financial Reporting Standard and Indian Accounting Standard. So IFRS stands for International Financial Reporting Standards. So it is prepared by IASB, International Accounting Standard Board. So what is the full form of IFRS? International Financial Reporting Standard, and it is prepared by whom? That is IASB, International Accounting Standard Board. It is used in around 144 countries. So here IFRS is an international, whereas this is confined only to India, Indian Accounting Standard. So this IFRS, it is used around 144 countries and is regarded as one of the most popular accounting standards. So it is one of the most popular accounting standard because it is followed by 144 countries. Indian Accounting Standard is also known as, that is INDAS, is also known as Indian Accounting Standard or Indian version of IFRS. So both seems to be similar, but IFRS confines to whole world, that is 144 countries, but Indian Accounting Standard is confined only to India. Indian Accounting Standard or INDAS is used in the context of Indian companies. So hope you know a bit difference between Indian Accounting Standard and IFRS. Now let us see the difference here. Now if you see the definition, okay, so IFRS as the abbreviation itself tells us International Financial Reporting Standard. It is an internationally recognized accounting standard. So it is internationally recognized, which means that it is used outside India also. Indian Accounting Standard, INDAS, stands for Indian Accounting Standard. It is also known as Indian specific version of IFRS, but it is only confined to India. Next, second is developed by. So IFRS is developed by IASB, that is International Accounting Standard Board, whereas INDAS, that is Indian Accounting Standard, is developed by MCA, Ministry of Corporate Affairs. So hope you know the two difference now. Followed by, yes, this is internationally it has been followed by 144 countries across the world, that is IFRS. Whereas Indian Accounting Standard only followed in India. Okay, so that would be the third difference. Next, disclosure. So companies complying with IFRS have to disclose as a note that the financial statement comply with IFRS. So those companies who are following IFRS, they have to write a note that they are following the IFRS. Such a disclosure is not mandatory for companies complying with Indian Accounting Standard or INDAS. So they need not write a note that they are following Indian Accounting Standard. But in case of IFRS, any company is following IFRS, they have to write a note that they are following IFRS. Next is financial statement components. Let's see what are the financial components in IFRS as well as Indian Accounting Standard. It includes the following. That is statement of financial position, that is your balance sheet, statement of profit and loss, statement of changes in equity for the period, and statement of cash flows for the period. So these are the components which are included in IFRS. Whereas in Indian Accounting Standard, it includes balance sheet, profit and loss account, cash flow statement, statement of changes in equity, notes to financial statement, disclosure of financial policies. So these are the components which are included there. Next, a balance sheet format. Let's see how the balance sheet format will be in IFRS and Indian Accounting Standard. Companies complying with IFRS need have specific guidelines for preparing the balance sheet with assets and liability to be classified as current and non-current. So here they have to clearly specify the current asset and current liabilities, that is current and non-current. Next, coming to Indian accounting standard, companies complying with Indian accounting standard need have no such requirements for balance sheet format, but the guidelines are defined for presenting the balance sheet. Guidelines will be given, but no such requirement is there for Indian accounting standard. So this would be the main difference between IFRS and Indian accounting standards. So my dear students, hope you have understood today's session. See you all in my next session with a new concept. Till then, take care. Thank you.